Weekly mortgage applications falling in the latest release that was out this morning, putting further pressure on the housing sector as it faces headwinds from tariffs and macro slowdown concerns. Joining us now is Dallas Tanner, the CEO of Invitation Homes. And Dallas, it's great to have you back on the show. And that's where I'm going to start with you, because we've been talking about the health of the consumer. We know housing has been sluggish. You're in a very particular piece of the housing market, single family rentals. What are you seeing in terms of the customer base, the health of those consumers, and what that means for the housing market?
You know, we talked about this morning with our group, and we're just not seeing a whole lot of change currently with our current customer. Maybe a little bigger propensity to renew than we'd seen in years past, and that might have something to do with the for sale market. There's certainly plenty of supply in the resale market today. Our customer feels, pretty convinced that renewal's, most likely the best option, with the affordability being so drastically different between ownership and for lease today. On average in our market, it's about $1,100 cheaper on a monthly basis to lease the same home when you take the considerations of homeowners insurance, property taxes, and the like. And so as you start to think about that imbalance, it's certainly favorable to a customer who wants to rent.
What do you think it takes to see that imbalance narrow? Is it going to be mortgage rates continuing to come down and more inventory in general coming online?
It's a great question. I mean, there's a couple of things going on, right? First, you still have a little bit of the lock-in effect based on everything that we read and sort of follow in terms of people out there with good existing mortgages. I think to see mortgage rates come in obviously would help. There's going to have to be some catalyst probably for that. The supply story is pretty good right now if you're somebody in the market looking for a home. I think the affordability factor is a little bit of an issue with the elevated rate environment that we're in right now. But the customer that we keep coming across feels pretty good. And look, I'm biased to the for lease space, obviously, right now, but we work with a ton of different builders around the country. We're building 2,000 to 3,000 homes a year for the purpose of flexible housing arrangements. And, builder business sounds pretty good. It sounds like they're giving a little bit more away in some of the public market data that's out there from an incentive perspective. There's still people transacting. So it's sort of hard to read if it goes sort of one way or the other quickly. I think we're sort of where we are right now. It's going to take some sort of a catalyst to move rates.
Yeah, and you don't construct the homes, but you do work with a number of home builders. So how are you gaming that out in the midst of tariffs? And we already have tariffs on some lumber products that come into this country from Canada, for example. But with all the talk that we could see more, plus factor in immigration and the impact that could potentially, and crackdowns there, and the impact that could potentially have on a workforce for the construction sector, what are you expecting?
So, taking a step back, a healthy housing environment has both the right balance of ownership and flexible for lease product, and that could be a number of different things. As we've talked with our partners, both public, private, and we're trying to get a better sense of where we think potential risks exist, there certainly are areas like that you mentioned around lumber and steel and some of these areas that will either happen directly or indirectly as they pass through to vendors in the plumbing, markets and in the framing markets, et cetera. So we're underwriting a little bit more risk there, but we still see on a balanced view that given the demand and the need for more housing in this country, that there's still going to be ability to bring, high quality housing, both in the for sale and also in the flexible for lease areas of the markets that we're involved in a meaningful way, because the demand's just there. But I do think as an entrepreneur, as somebody who is investing in housing, they're certainly taking some of that risk into their underwriting models as they think about their return profile.
Some of the markets that we've seen be the hottest and most sought after in recent years seem to be shifting here. Case in point, Florida. You have a lot of investors appear to be pulling out of Florida right now. The supply of homes for sale is the highest on record, according to CNBC's Diana Olick. Is it a good market to be in?
I still think Florida is a really healthy market. And you say, well, why? And remember, just taking a step back, like trees don't grow to the sky. So at some point you get back into sort of a seasonality, or to your point, maybe in certain pockets, things have been maybe a little bit overbuilt, but that absorption will happen naturally. You have a very friendly government that's pro-housing, pro-business. I think the governor does a nice job in that state. There's a lot of opportunities to invest. It's warm weather, great demographics, net household migration's pretty good, and the markets all behave a little bit differently. Miami's very different from Orlando and Tampa, Jacksonville, et cetera. And we're in all those markets with our company. We love being there. We think the customers are terrific. We think the environment's very friendly in the for lease space. There's certainly going to be a little bit of noise. We talked about this in our fall earnings call, that we saw a little bit more supply coming into the marketplace, especially in the build to rent category. And so it'll take a few quarters for some of that to absorb. But if I had to make a bet, I don't think people are leaving Florida. It's a great place to live, a great place to do business.